Great to have you back, Chris. So overall, what's options activity telling you about the next move in this market?
Well, every option indicator under the sun, every volatility indicator, sentiment positioning, et cetera, all screaming for a near-term bounce. Obviously, the longer-term U.S. economic growth, recession or not, that's going to indicate, the longer and medium-term stock market direction. But all those traditional capitulation indicators, VIX term structure, put-call ratios, AAII, bull bear, that have worked so consistently over the last 12 years are flashing right now. I would obviously point out that, the last 12 years, we've had a mostly accommodative Fed, relatively low inflation. So you've got to keep that in mind. But those traditional options, time for a rebound indicators are flashing right now.
In other words, you're saying we could see a little bit of a bounce here. It's funny. I know people feel bad being bullish right now because that's the kind of market that we're in.
Well, yeah, and I'm talking about a near-term bounce. So one parallel that we've been looking at recently. So the last 2 Fridays, 97% of S&P components sold off. That's a broad, all hands on deck sale where investors are aggressively unloading risk into the weekend. That has not happened in over 10 years. The last time that happened was in 2011, September. So the good news, that was towards the end of that bear market. And we did see a pretty sharp bounce right afterwards, about 6 or 7%. The bad news, from the low on that second Friday, S&P still traded down another 6%. So a lot of these parallels, I wouldn't necessarily say bullish in the medium term, but a lot of these parallels do point out that, we are due for one of these bounces, and we'll see if we get it.
Well, who knows? I mean, yesterday, Kelly, when you and I got off the air, we were down about 500 points, and then I go home and I find that we've ended up by 85 points. So maybe that bounce is in there after that Friday phenomenon that you just referred to. You point also to retail option trading, that small lot call activity remains near pandemic lows and that has been on the rise, suggesting that retail investors are chasing downtrends, chasing. When they do that, is that a signal? A contrary indicator, let me put it that way.
Well, yeah. So here's what I would say. I mean, if we think back to 2011, meme stocks, call volume, all those things, it was a strong market to the upside. We saw a lot of small lot call volume. Now, fast forward to right now, that small lot call volume is back down towards post-pandemic lows. Now, not necessarily seeing a surge in retail put volume, but it's definitely way more, evened out compared to, the frothy 2011.
And
2021.
2021, yeah.
What are you garnering here about dividend plays, that they're becoming less attractive?
Well, you mean just today, and we've been looking at this for a little bit, so I'm talking about the consumer staples that pay the higher dividend. We've seen a ton of put buying, put spread volume in the XLP, already an all-time high in put volume for that product. We're also seeing similar, this is all in June, similar put spreads being bought in Coca-Cola and J&J. And it kind of goes back to that 95%, all hands, everything gets sold at the same time kind of sell-off. The consumer staples have held in a lot better. But if we get, a final flush of everything in the market, you're getting much lower, much cheaper volatility exposure in a lot of those names. So if everything gets hit the same, or if the outperformers get hit more, that's a good place for risk-reward downside plays as hedges.